Welcome to the Spreadex weekly financial market preview. I'm joined again by analyst Connor Campbell. Connor, what should traders be looking out for this week then?
I guess there's a lot of stuff for the pound to deal with this week. You know, since the middle of April, it's had a really awful time of it. You sort of have to feel sorry for it a bit. I think at the middle of April, it was trading at post-Brexit lows, post-Brexit highs, against the dollar. It sort of was seeming to be a May rate hike from the Bank of England locked on. You know, it was riding high off the back of that, and then since then, it's just sort of been battered into the ground. Really, you've had a string of bad data. You've had dovish comments from Mark Carney. You've had a really bad first quarter GDP reading for the UK. So it seems to have wiped away any hope of a May rate hike and has basically left the pound trading against the dollar at near 15-week lows, which is quite a turn down from where it was in the middle of April. In terms of this week, there are a few things that could go its way, but it really depends on how things perform on the US side of things, basically. On Wednesday, you've got the Fed meeting. That's not meant to be a particularly exciting Fed meeting. There's not going to be any rate hikes or anything like that. However, the Fed could use that meeting to sort of tee up potentially 3 more hikes in the rest of the year, the earliest being one in June. So dependent on how hawkish the Fed is on Wednesday, that again could keep the pound at those lows. On the UK side of things, you've then got the construction and services PMIs on Wednesday and Thursday. I think both of those are expected to bounce back from March, which was hurt by the March readings were hurt by the beast from the east and the impact of the severe weather. I think both of those are expected to rebound. How much of a boost the pound gets from that, I'm not quite sure. Though investors should be pleased if those figures come in accurately. Investors should be pleased to see that the start of the second quarter has improved after that really awful first quarter. And then heading into Friday, you've got the non-farm jobs report. I think broadly expected to be fairly positive. I think unemployment rate is expected to fall from 4.1% to 4.0%, which will be, I think, a 42-year record or something like that. Wage growth, however, is expected to slip from 0.3% to 0.2%, which may be a concern for dollar hawks on the lookout for a rate hike in June. From our clients' perspective, they've been fairly aggressively buying since the pound fell below $1.37. You know, like I said, it's at 16-week lows. I think our clients are fishing about for the bottom, hoping that, given how dramatically it's fallen in the last couple of weeks, that any slight positive will have a disproportionate effect on the pound and perhaps lift it back towards 138 and hopefully 140.
Okay, we shall see. And looking at stocks then, companies reporting this week, looking at Apple.
Yeah, Apple's easily the biggest company reporting this week. You know, huge ramifications not only for the company's stock price, but likely the Dow Jones as well. It's not had a great 2018, which is interesting to say given that I think it hit $183 all-time highs at the start of February. Since then, it's been on a sharp decline, largely due to fears over the iPhone, namely the iPhone X. I think reports have come out suggesting that the iPhone X is basically dead, that there won't be a second generation of the iPhone X after this current one. There just hasn't been the demand for it. I think Apple perhaps shot themselves in the foot after releasing the iPhone 8 and the iPhone X at the same time. The iPhone X is substantially more expensive without actually being much of an improvement tech-wise on the iPhone 8. However, I think analysts are still expecting to see the company post a 4% increase year on year for the second quarter in terms of iPhone units sold to like 53 million, which is not too bad. In terms of revenue, I think revenue is expected to come in between 60 million and 62 million for the quarter. At the midpoint, that's a 15% increase year on year as well. So again, not too bad. I think it really depends on how receptive investors are going to be to what is a fairly meagre increase in iPhone sold. However, given the negativity around the stock at the moment, even that 4% increase might be seen as an improvement. From our clients' perspective, they've been fairly heavily selling Apple around the $163 mark, which I will say is rare. You know, Apple tends to be a stock that people buy regardless of the wider news, but at the moment, perhaps the tide is turning against the stock, and there are longer term issues for the company to deal with as well. Specifically, a lack of, I guess, robust change between generations of iPhones is going to convince people to hold on to their smartphones longer, which is going to reduce, the sort of smartphone cycle is going to get longer. It's going to reduce people's appetite for buying the next iPhone. And whilst it'll still be a big event each time one comes out, you might not see the same kinds of queues, out of the Apple Store on the evening of those iPhones being released.
Yep, okay, that's interesting. And then Trinity Mirror?
Yeah, Trinity Mirror is sort of mired in some M&A dispute at the moment. Technically it has actually bought the Daily Express and the Daily Star and their Sunday versions, and OK magazine. That's secure. However, the CMA, I think towards the start of April, announced they were doing a phase 1 inquiry into the deal, which I think is related to trying to ascertain whether or not that deal is going to suppress competition, I guess, in the newspaper sector. And on top of that, Culture Secretary Matt Hancock said that he's minded to do an intervention with the deal and try and reverse the deal after broadly looking at a wide selection of evidence, and has asked Trinity Mirror to now supply more evidence to try and convince him not to do that, which that's a fairly sizable issue for the stock. I think back in March with its full year figures, the company's CEO Simon Fox was fairly confident that the deal, the CMA wouldn't be a major impediment to the deal. Obviously the deal's secured, but in terms of integrating the Daily Express and the Daily Star into Trinity Mirror's company, which Trinity Mirror is so confident that it actually wants to rename itself as Reach, reflecting its sort of broader expanse of title. So that is now in serious danger, and I think investors will be desperate for some kind of update on Thursday as to when they can expect some kind of decision from both the CMA and from the Culture Secretary Matt Hancock, and what the company feels like at the moment and whether the deal is going to go through. And then I guess what happens from there, given that they have actually bought those titles, but now at the moment they're sort of existing in limbo as an entity separate from Trinity Mirror itself. In terms of what our clients are doing, they've been selling the stock around the 85p mark, not only on the news of sort of this title dispute, but also on the fact that I think back in March with its full year figures, it said for the first 2 months of 2018, like-for-like sales had dropped 9%. That's worse than the 8.8% drop seen for its full year figures and the 8% drop seen the year before. So unless it can post an improvement on that across the first quarter as a whole, maybe just get it back towards the 8.8% mark, then it might be looking at an ugly reaction from investors on Thursday. Hence explain why our clients are selling around the 85p mark.
So clients are not too confident.
No, not too confident.
And finally, International Airlines Group, so IAG.
Yeah, it's had a fairly decent set of figures earlier in the year. I think passenger revenue was up 1.6%, total revenue was up 1.8% to just shy of 23 billion euros, which is huge. I think operating profit was up 19% to 3 billion euros, which again, massive figures. I think the main issue going into Friday will be Norwegian Air. You've seen earlier, I think it was earlier in April, that IAG took a 4.6% stock in Norwegian Air. There's then been speculation since then that IAG might go completely in for Norwegian Air and buy up the low-cost carrier. Since then, I think Norwegian Air has said that they've also had offers from other companies and stuff, so I think investors are going to want some kind of clarification on where exactly IAG stands in terms of its position towards Norwegian Air and whether it's serious about actually taking the company on completely. In terms of our clients, they've been buying around the 6.25 mark. Now, since I think IAG hit all-time highs earlier in the year, but about since mid-February, really, it's been trading fairly solidly between £6 and 6.25. So our clients are buying at the top end of that, the 6.25 mark. But I will say not with such confidence that it couldn't just remain at the top end of that bracket and not break beyond it on Friday.
Okay, very good. Thank you very much, and that's all for this week.
Thanks very much.